What if the government built legal shortcuts that let ordinary citizens keep thousands more of their own money every single year? Deep beneath Aurovale's neon-lit metropolis, 3 tunnels sit open that most citizens walk right past. They're real, tax-advantaged retirement accounts, and most working adults never fully use them. Tax-advantaged means the government grants a specific legal benefit, either a deduction today or tax-free growth tomorrow, that cuts what citizens owe on investment gains. It's not a loophole. It's written directly into the tax code. The first tunnel is labeled 401k. An employer sponsors this account. The company where a citizen works acts as gatekeeper. Contributions come directly from a paycheck before taxes are calculated, shrinking taxable income the moment they land. In 2024, the IRS allows workers to contribute up to $23,000 annually into a 401k. Workers 50 and older can add an extra $7,500, a provision called the catch-up contribution, built specifically for late starters. Here's where the 401k tilts sharply in the citizen's favor. Many employers match a percentage of contributions, commonly 50 cents per dollar, up to 6% of salary. That match is an immediate, guaranteed 100% return on every matched dollar. But the 401k tunnel has a locked gate at the far end. Withdraw before age 59 and a half, and citizens pay ordinary income tax plus a 10% early withdrawal penalty. The shortcut demands patience. The second tunnel, the traditional IRA, differs in one crucial way. Any citizen with earned income can open one independently, no employer involved. Ledger calls this the citizen's personal tunnel. No gatekeeper required. The 2024 IRA contribution limit is $7,000 annually, with no additional catch-up contribution for those 50 and older mentioned in the search results. Contributions may be tax-deductible, depending on income and whether a workplace plan already exists, so the benefit shifts by citizen. The traditional IRA runs on a defer now, pay later principle. Investments grow without annual taxation. No capital gains bill every December. The government collects its share only when citizens withdraw in retirement, when their tax rate is often lower. Here's the twist that recasts everything. The third tunnel, the Roth IRA, runs the logic completely backward. Citizens pay taxes on money before it enters. Inside, it grows entirely tax-free. Withdrawals in retirement cost nothing in federal taxes. Consider a citizen who contributes $7,000 annually into a Roth starting at 25, assuming a 7% average annual return, a historically conservative equity market figure. That account reaches roughly $1.9 million by 65. Every dollar of it tax-free. But the Roth tunnel has a velvet rope. In 2024, single filers begin losing eligibility for Roth IRA contributions at a modified adjusted gross income of $146,000. In 2024, Roth IRA contributions phase out entirely for single filers earning $153,000 or more. So, which tunnel first? Ledger's answer is precise. Fund the 401k up to the employer match. That's free money. Then fill a Roth IRA to its annual limit. Then return to the 401k and maximize the remaining contribution space. The employer match comes first because no investment on earth guarantees an immediate 50 to 100% return. Skipping the match to prioritize anything else, even a Roth, is mathematically identical to leaving earned wages on the floor. These tunnels aren't reserved for Aurovale's spire dwellers in Compound Heights. A citizen earning $30,000 annually can open a Roth IRA today at any major brokerage with as little as $1. The tunnel isn't the investment, it's the container. Inside a 401k, IRA, or Roth, citizens choose what to hold: index funds, target date funds, individual stocks, bonds. The tax advantage wraps around whatever investment strategy the citizen selects. Many employers now offer a Roth 401k, a hybrid combining the higher contribution limits of a 401k with the tax-free withdrawals of a Roth. The 2024 limit mirrors the traditional 401k at $23,000, but every dollar withdrawn in retirement is tax-free. Here's a constraint most citizens miss until it's too late. Traditional 401k and IRA accounts require mandatory withdrawals starting at 73, called required minimum distributions. The IRS won't let tax-deferred money sit untouched indefinitely. Roth IRAs carry no such requirement. That asymmetry makes the Roth tunnel especially valuable for younger workers in lower tax brackets today. Paying a 12 or 22% rate now to lock in decades of tax-free compounding beats deferring taxes only to pay a higher rate in a wealthier retirement. Time is the most powerful variable in this equation. A citizen who contributes from 25 to 35, 10 years, will typically outperform one who starts at 35 and contributes for 30 years, assuming identical returns. Compounding rewards early entry above everything else. Ledger's most sophisticated point: hold money in all three tunnel types simultaneously, if possible. Carrying pre-tax 401k funds, Roth after-tax funds, and taxable accounts give citizens the flexibility to manage their tax bracket deliberately each year in retirement. High earners above the Roth income threshold aren't permanently locked out. A legal strategy, called the backdoor Roth, lets them contribute to a non-deductible traditional IRA, then convert it to a Roth. The IRS permits this conversion explicitly. The most common reason citizens never enter any tunnel isn't income. It's decision paralysis. These accounts feel complex from the outside, but Ledger's rule is blunt. A mediocre fund inside a Roth IRA beats a brilliant fund in a taxable account almost every time. Consider what non-participation costs over a lifetime. A citizen investing $7,000 annually in a taxable brokerage account, paying 20% in annual capital gains taxes, accumulates roughly 40% less wealth over 40 years than the identical investment inside a Roth IRA. Consider a 28-year-old teacher in Oroville earning $52,000 annually. Her school district offers a 403b, the educator's equivalent of a 401k, with a 3% match. She also qualifies for a full Roth IRA contribution. 2 tunnels, both open, both untouched. If she contributes enough to capture her full employer match and maxes her Roth IRA starting today, she'll have put in approximately $341,000 over 37 years. At 7% annual return, that account reaches $1.6 million, tax-free at retirement. At the top of this episode, the question was whether the government actually built legal shortcuts for ordinary citizens. The answer is unambiguously yes. The traditional IRA has been open since ERISA created it in 1974, and the Roth IRA followed when Congress added it through the Taxpayer Relief Act of 1997. Compound Heights didn't grow wealthy by earning more than everyone else. It grew wealthy by using these tunnels consistently, early, and at maximum levels. Those tunnels gradually widen. The IRS adjusts contribution limits annually for inflation, so checking the current year's figures each January is a 30-second habit that ensures citizens never leave contribution space on the table. The single most consequential action any citizen can take today isn't choosing the perfect fund, it's opening the account. An empty tunnel still beats no tunnel. This week, open a Roth IRA at any major brokerage. Set a recurring contribution of even $25, and let the tunnel do what it was legally built to do: compound your wealth free from federal tax for the next 40 years.